What's going on, everybody? Welcome to week 2 of Option 101. We will get started at 7:35, but glad that y'all went ahead and came on in. Let me make an announcement. Welcome, everybody. We'll get started promptly at 7:35 p.m. Hope all of you had a great Wednesday. Sure, Brittany. I'll give you the chance to unmute yourself. Go ahead.
Right, thank you. Has nothing to do with options or anything. Just wanted to know if there was a ticker for the company called, I believe it's called Ripple. It's the currency for XRP.
Yeah, I didn't hear the first part of the question. Could you repeat that?
Is there a ticker for the company Ripple?
No. So there's not an actual stock ticker for Ripple. Of course, you already kind of alluded to the cryptocurrency, but there's not an actual stock ticker yet for the company Ripple.
Okay, perfect. Thank you.
No problem. Again, the question was, if you attended last week's class or watched the recording of last week's class, drop a 1 in the chat. If you have not or did not, drop a 2. Okay. Seeing a lot of 1s, loving that, loving that. For those that did not attend last week's class, I will go ahead and show you very quickly where you can find that information before we get started. So let me go and share. All right, so if you go in the Discord, come down here to the class recaps. We have the raw recording, which is the YouTube link, private YouTube link. And then we have the AI recording, which comes with notes and a transcript and some other cool features. So both of those are available to you under the class recap section. All right, and this will, of course, will be where I post tonight's recap for week 2's class. Right. Also, definitely make sure you all check out that review section. I always love when you all leave reviews for me to read about your experience in the class. I take the time to read anything that's posted in here so that I can continue to provide value to you all as a educator. So let's go ahead and get started with tonight's class. All right. So last week we discussed what an option was, right? And ultimately, based on that definition, we were able to kind of talk about what drives option value, right? So this week we're going to kind of dive a little bit further into the concepts of what drives value, right? What actually makes the option premium, right? So if we recall from last week, excuse me, where is that at? Thought I had a slide on it. But as we recall last week, when we buy an option, right, the value of that option is referred to as a option premium, correct? So usually when we see that option premium, it looks like, let's just say 250, right? And we know since last week we talked about what an option contract represents. It's actually a contract that represents a lot of 100 shares of a certain stock, right? So if you ever wondered, right, why the option premium might say $2.50, but when you actually go to buy the option contract, it equals $250, that is because the option premium is per share, right? So essentially, to own that contract, you are paying a $2.50 premium per share, right? There are 100 shares in that contract, which makes that contract worth $250. Okay, right? But what drives the value of this option premium, right? And the three main factors that we just started to discuss last week was volatility, time, and direction. All right. So we had a couple of different examples of each one of these. We talked about it in reference to the aftermarket resale for a car, right? And we talked about, how when we look at a contract, an option contract, depending on if it's a favorable contract when we purchase it or if it's an unfavorable contract when we purchase it, will determine if it's a very valuable contract or if it's not a valuable contract, right? So, just a quick review. What contracts are more favorable? In the money, out of the money, or at the money contracts? Which contracts are more favorable? Put your answer in the chat. Correct, right? In the money contracts are more favorable, right? Now, what contracts are less favorable, right? In the money, out the money, or at the money? Right? And what is pretty much, indifferent? Which contract is considered indifferent? In the money, out the money, or at the money? Right. At the money contracts. And for those that forget, when we're looking at that, right, on a Robinhood screen, we will notice that, on the call side, out of the money contracts tend to be above the share price, right? On the put side, out of the money contracts are below the share price, right? The at the money contract on the call side is a contract right above the share price. On the put side, it's also the contract right above the share price, right? And then in the money on the call side is below share price. In the money on the put side is above share price, right? So essentially, these contracts, what we try to do, or what as option buyers, we make the most money when we're able to buy contracts that are out the money or at the money and allow them to transition to be in the money when we sell them, right? Now, contracts do not have to be in the money when we sell them, but the progression of them going in the money makes those contracts more valuable, right? So it might be $250 when we bought it, right? And we hold it for a couple of days, and now it's $350 as that contract moves closer in the money, right? Now, what determines if a contract is in the money or out the money, right? What determines that? What do you all think determines if a contract is in the money, at the money, or out the money? Of course, the strike price, but essentially, exactly, right? The current price, right? Depending on where your stock price is, will determine if a contract's out of the money, in the money, or at the money, right? So we know that our stock price moves up and down all day, right? So as that stock price fluctuates, contracts can be in the money, or if it fluctuates and it moves away from you, that contract might go out of the money, right? Or the opposite, right? A contract might be out of the money when you purchase it and it moves in your direction, and now it's thus in the money, right? So the big factor that determines if a contract is in the money, at the money, or out the money is stock price, right? And that goes back and relates to one of the main drivers of option value, which is price direction, right? When price is going up, right, calls are becoming more expensive, puts are becoming less expensive. When price is going down, puts are becoming more expensive, calls are becoming less expensive, all right? Now, how does volatility come and play a factor into that, right? So last week we talked about, in reference to, we talked about certain stocks, right? And we realized that stocks that are usually more expensive tend to have option chains or option contracts that are more expensive than stocks that are less expensive. So for an example, if we were to look at, options on NIO, and NIO is like a $5 stock. It's a Chinese EV stock. And we compared that to options on Tesla, which we know is like a $350 stock. We know that the options on Tesla are vastly more expensive than the options on NIO, right? And we know that to be true is because Tesla has the ability and has shown through history, the ability to be more volatile, right? There is more price movement in Tesla than there is in NIO, right? And as a option seller, right, because we know on both sides of the trade, there's an option buyer and there's an option seller. As a option buyer, right, as a option buyer, we know that we have to compensate the option seller for the volatility they have to endure while they sell us this contract. Okay. So we talked about direction, we talked about volatility, and then lastly, we kind of rounded up with time, right? We talked about the longer we have till expiration of our contract, the more expensive that contract is going to be, right? And where we left off last week was that these factors, volatility, time, and direction, when you actually put numbers to these factors, they're referred to as the Greeks, right? So, kind of a brief overview of what we talked about last week, and kind of a nice segue into what we're going to be talking about tonight, right? So, if you are familiar with the Greeks, drop a 1 in the chat. If you're not familiar with the Greeks, drop a 2. So, a lot of times Greeks are some of the hardest things, is one of the hardest things about options. But essentially, Greeks are what make options options. So let's kind of dive into what Greeks actually are, right? So with Greeks, there are 5 major Greeks, right? Delta, Theta, Gamma, Vega, and Rho. All right. So we're going to color code these really quickly. All right. So Delta and Gamma are what I like to call price action Greeks. Okay. What I mean by price action Greeks are delta and gamma. The number that is shown with the delta and gamma value tell you how price action affects the option contract, right? So it tells you by if this stock goes up or if this stock goes down, how will this affect my option contract? Delta and gamma are the 2 Greeks that tell you that, all right? Now remember, going back on our thing, there are 3 main drivers of option value. So we talked about direction or price action, right? That's going to be delta and gamma, all right? Now, theta, good old theta. Theta is our time Greek, all right? It's our time Greek. Theta tells you that basically as time passes on, how does that affect your option contract? Now, remember from a high level, when we thought about it from a high level concept last week, that we understood that if I had more time till expiration, that these contracts would be more expensive. Well, Theta tells you from once you buy that contract and that ticker or that countdown starts, right? Let's say you have 90 days till expiration and you buy it, so now you're on the countdown from 90. How each minute, each day passes by, how does that affect your option contract, right? That's what theta tells you. So that's your time Greek, all right? Then we have good old Vega, all right? Vega is your volatility Greek, right? Vega tells you as the stock's volatility increases or decreases, right? How does this affect your option contract, right? And then lastly, we have the most uncommon Greek, right? The one that nobody really talks about, which is Rho, right? And Rho tells you how sensitive is this option contract relative to interest rates, right? So these are your 5 major Greeks. Okay, these are your 5 major Greeks: Delta, Theta, Gamma, Vega, and Rho. Okay, so I gave you all kind of high level definitions of them. Let's get a little bit more into the actual details, right? So Delta tells you the marginal change in contract price given a dollar move in underlying stock. All right, so we're going to take a look at the option chain and see exactly what that means. So right now we're looking at a TOS option chain, okay? And I'm going to pull up Tesla, right? I typed in Tesla, right? Now, on this option chain, as you see, we got our expiration dates. Once we choose the expiration date, we see our strikes in the middle, okay? So I'm just going to put on our Greek layout. So I went up here. Let me make sure y'all can see this. So I went up here, chose my Greek layout, Delta, Gamma, Theta, Vega, right? So I'm able to see the Greeks associated with each contract, okay? So when I look at, as you see, Delta usually is a value between 1 and -1. So where's my annotation tool? So Delta can be between 1 or -1 to 1, right? So for the call side, Delta can be between 0 and 1. For the put side, Delta can be as low as -1 to 0. Okay. Now, the formal definition of Delta is the marginal change in contract price given a dollar move in underlying stock. So what does that mean, right? Let's just say the market was open. We see that Tesla's trading at $360.56. If Tesla went to $361.56, so it made a dollar move to the upside, Delta tells you how much your option contract's going to change in price. All right. So if Tesla made that dollar move and we were looking at these 365 calls, we could expect that this contract would go up by 46 cents or $46 a contract. Okay. If that makes sense, drop a 1 in the chat. Okay. Now, what do we notice on the put side about Delta? Right? What do we notice? Does it have to be a whole dollar? No. Right? Delta is standardized on a dollar, but technically it can be broken down. You know, if it moved 10 cents, then we could suspect that instead of that contract changing by 46 cents, it would change about 5 cents. It would go up about 5 cents. Does that make sense? Did everybody catch that question? Because that was a good question. She said, does it have to be a whole dollar for Delta to have an effect? No. Delta is a dynamic metric, right? So even as option prices change, your Delta value is changing, right? But as a rule of thumb, it's fluid, right? So if a full dollar would give me a 46-cent move in option contract price, then I could estimate that if the stock only moved 10 cent or 50 cent, let's just do 50 cent. Let's say the stock moved 50 cent, that instead of me getting a 46-cent move on the option, I would get a 23-cent move on that option because that's about half of 46. and 50 cents is half of a dollar, right? So again, delta does move fluidly, right? And this is important, right? Like especially when you're scalping, right? When you're scalping and you're not looking for really big moves, right? If you know the delta value when you get in the contract and you're maybe looking for a dollar move, you can kind of suspect how much your option contract's going to go up in value, right? Oh, I'm just trying to get a dollar move on Tesla, right? I think we're going to pop a dollar, right? Well, okay. I'm looking at these contracts. They cost me $9.20 or $920 a contract. I know if I get that dollar move, these contracts that were $9.20 are going to be about $9.65, right? So this is a way that you can start to plan out, your trades and start to plan out your thoughts based on the expectations you have for a move that you're looking for in a stock. All right. Now, when we look at delta on the put side, one thing that you'll notice that delta is negative, right? Now, that goes back to the actual definition of delta, right? The definition of delta was the marginal increase in option contract price given a dollar move to the upside in underlying stock, right? So when the stock that the option is based off of goes up a dollar, delta tells you how much that option contract is going to move, right? Well, if we're looking at puts, right, and we think about puts, when we're in puts and we buy puts, we want the stock price to go down. So if the stock price went up a dollar, it would make sense that delta is negative, right? That it would actually hurt your contract rather than help it, right? So essentially, right, if we looked at, let's say we were looking at these 360 puts, and I'm gonna clear out my screen real quick, clean it up. So let's say we were looking at these 360 puts, right, and we see that this has a delta value of negative 47, right? So if Tesla again went up from 360.56 to 361.56, right? If it went up in price, we could suspect that this contract that's worth about $10.50 or $1,000 or $1,050 would go down about $47 in price based on that dollar move to the upside in Tesla, right? That's what delta tells us, okay? So delta for calls is positive, delta for puts is negative, all right? And again, delta tells you how a contract will be affected by price movement. Now, what is another thing that you notice about delta, right? When you look at all of the strikes listed, what do you notice about the delta, right? What do you notice? What's one thing you notice? Type it out in the chat. What's one thing you notice about delta as you look at all the different strikes? You can type it out, or I will give you all the chance to unmute yourselves because we do have a smaller class this evening. Give me a second. Y'all can unmute yourselves. What do you all know about delta? Talk to me. Ralph said he sees a price increase, right? So if you're looking at contracts that are all the way out of the money versus contracts that are all the way in the money, because remember the purple on TOS is in the money, the black is out of the money, right? We notice as we go from out of the money to in the money contracts that the delta value increases. Right? Same thing on the put side, right? When we go from out of the money to in the money, we can see that the delta value increases, right? So what does that tell you, right? Well, what that should tell you is that in the money contracts right, are more sensitive to price movement. In the money contracts are more sensitive to price movement, right? Because if Tesla makes this dollar move from 360 to 361, if I'm looking at these 370 calls, this contract's only going to move up 40 cents. But if I was looking at these 350 calls, well, this contract's going to move up 67 cents. So just comparing the delta values, I can see that that same dollar move has a larger effect, right? Yields me a larger amount for my money for that dollar than me having an out of the money contract. Does that make sense? If that makes sense, drop a 1 in the chat. If you didn't follow that, drop a 2. Okay. So we know that out of the money contracts, right, are less sensitive to price movement. Tell me if this has ever happened to you, right? And I'm gonna bring it home. Hopefully, bring this concept home. Tell me if this has occurred. You've seen a signal in a community, whether it was Impact or another community that you may have traded in, and you look at the option, right? And let's say they were looking at some Tesla calls, right? And those Tesla calls were $500, right? Or let's just use for an example. We were looking in the group, and tomorrow I call out Tesla calls, and I called them out at the 362.5 strike. So those contracts are almost $1,000, right? And you say, you know what, man, I can't pay. I ain't trying to pay no $1,000. I don't know what TJ on today. I'm not paying no $1,000 for this contract. But you're like, you know what? I would be willing to pay 500, around 500. So instead of you maybe buying the 362.5s that were alerted, you come down here and you come to buy the 375s because those are a little bit more affordable, right? And what you might notice is Tesla's getting the moving, and the trade is progressing, and everybody, I'm signaling, all right, I'm up 10%, I'm up 20%, okay, I'm out of the trade, right? And you go back and you look at your contract, and you say, damn, my contract ain't moved. And a lot of times that's because I'm closer in the money, I'm getting a bigger return for every dollar movement compared to you. So if the move is not large enough or is not prolonged enough, you will not be able to see your contract move as fast because it needs a larger move to see the same return, just from an absolute dollar amount. Daniel brings up a good question. He said, can I explain why the out of the money contracts can make you more money than others when they have a smaller delta? Right? So this leads to the art of selecting a strike, right? So when you buy a contract, your delta is not locked in, right? It's not locked in. That is just the delta value when you bought that contract. So if I bought these 375 calls on Tesla, right, with a delta of 33 cents, and Tesla starts to move, and these contracts get closer to the money, right, this delta value is going to increase. Let me show you. I actually have a perfect visualization for this. I'm glad that you asked this question. It's a critical thinking question. All right. So let me show y'all something. So this right here. close all this out. This right here that we see, that we're looking at, is the delta curve. Right now, we know Tesla's trading roughly around 360. Okay, we see that Tesla's trading around 360. Right. So when you buy out of the money contracts, which are contracts, so the strike prices are on the y-axis. I mean, on the x-axis, the delta's on the y-axis, right? So contracts over here are out of the money, contracts over here in the money, right? And I'm gonna just throw another date. So this is the 21st expiration, which is Friday. The blue line is next week's expiration, right? So when we look at how delta changes, when you are really far out of the money, delta is low, right? Delta is very low, right? But as that contract gets closer to being in the money, right, and thus goes into money, delta grows, right? So Daniel's question was, how is it that you're able to buy contracts that are really far out of the money, and it seems like they yield a better return than you buying a contract in the money? Well, the benefit of that, or the reason is when you buy contracts that are really far out of the money, they are very cheap because they are unfavorable. But if you get a large enough move to where that delta value grows and each additional dollar yields a bigger return for the option contract, then essentially that unfavorable contract, which nobody essentially wanted, becomes very, very favorable. The only danger in that is if you don't get the move that you're looking for, then you just get stuck holding the bag, right? And that is the beauty of strike selection and what makes options options, right? Because the further out of the money you go, the less dollar return you're going to get for smaller moves. But if the move is very explosive, then you get to benefit from the growth of delta. Does that make sense? And delta, yes, delta caps at 1. Because delta on the call side can be as high as 1. Delta on the put side can be as low as -1. So essentially, let me show you something. If I showed you all the strikes, right, when you go really deep in the money, you're pretty much getting a dollar for dollar move. Every time the stock moves a dollar, the option is going to move a dollar, right? But essentially, as you start to scroll and you get further out of the money, and you go all the way out of the money, you see that, okay, if I was to buy some 440 calls for Tesla and the contracts expire on Friday, that even if this contract moved a dollar, even if Tesla moved a dollar, these contracts are not going to move, right? Because they have a delta value at 0. And they're probably not going to move for a while because even if I go a couple of strikes ahead, the delta value is still 0, right? So out of the money contracts, while they can be very, very lucrative, you just have to have knowledge on why you're going that far out of the money, right? Because essentially what you want to happen is to choose a sweet spot that allows delta to grow, right? So that you don't have to pay such a large premium up front, but as it grows, you start to get more and more for each dollar movement, right? So for an example, we're looking at these 380 calls, right? They have a delta of 0.11. But if Tesla really gets to moving, we can see as these strikes get closer in the money, how delta starts to grow, right? And that's ultimately what this chart is showing you, right? That pink line is showing you how fast delta grows as contracts go in the money. This is the reason why 0 DTE contracts, right, that are far out of the money, that when you buy them have very low delta, yield very fast profits because the delta is growing very fast. If I add more time, what do you notice about the delta curve as I add more time? It gets flatter, right? That means delta isn't growing as fast, which means your profits aren't growing or aren't as volatile. Does that make sense? Drop a 1 in the chat if that makes sense. And Brittany, I see your question. She said, where it said the bid on these contracts, and I'm assuming she's talking about lower here. She said, does that mean they're free? No, that does not mean they're free, right? That actually, I'm actually glad that you asked. I'm going to go back to this screen right here. Remember, the bid represents the max price the max price buyers are willing to pay for said stock or said option. So if you see a bid of 0, that means nobody's actually willing to pay anything to own that option. Remember, the ask price is actually the lowest price somebody's willing to sell you said stock or to sell you said option. As you see, all the ask here are 0.01, right? Because nothing in the market is free, unfortunately.
Can I ask a question really quick?
Yeah, go ahead.
So for the ones that said 0, is the bid price, is that the premium or is that not the premium?
Right. So the bid price, as I was saying, the bid price is just the highest price that somebody's willing to pay for said option. So it would be the premium, or the highest premium somebody's willing to pay. You as a buyer, right, are not really worried about the highest somebody's willing to pay. You're really worried about the lowest somebody's willing to sell it to you for, which is going to be the ask column. Does that make sense?
Yes, that makes sense. But what I'm trying to figure out is on that screen that you had before where all of the option chains were, how much would the contracts be for the ones that are that have 0 delta and the ones that were all the way at the bottom? How would
Oh,
you
so that would
determine?
just be $1. I mean, if you wanted to buy it, it'd just be $1 because that's what the ask price is. So, like for
Okay.
these right here that have 0 bid, you'll see that they do have an ask price of 1. So you could buy it, right? But essentially,
You can only see your PowerPoint right now.
oh, you can only see the PowerPoint. All right, let me go back. So like right here, right? Like you see the areas that have 0 bid, but then they have a ask price of 0.01, right? So if you wanted to buy it, you would just have to pay $1, but that's not something you want to do because there's nobody else to sell it to,
Okay, gotcha.
right?
Okay, thank you.
No problem. But this does bring up a good question, a good point that kind of matters with option valuation, right? So when we look at option price, right? When we look at option price, whether you're looking on Robinhood, whether you're looking on TOS, E-Trade, Fidelity, right? You'll have the bid, you'll have the ask, and you'll have this area that is the mark, right? And the mark price stands for market price, and it's the midpoint between the bid and the ask, right? So if you look at these 365 calls, you see the ask is 380, you see the bid is 370, so the market price is 375, right? One thing that you want to know about the market price is this is usually how your P&L is calculated, right? So let's say I bought this contract, these 365s, let's say I bought them for $2.50 or $250 a contract a few days ago, right? TOS would show that I have $125 worth of profit because these contracts are worth, or the market price is worth, $375, right? Now, while that all is all in good, it does bring a point that is very important for you to consider, right? That is an arbitrary price, right? There is technically nobody in the market that has a bid or has a ask at 375, right? So as a option buyer, right, you always want to be looking at the ask price because that is the price that you're going to have to pay. And as a option seller, or when you're selling your contract back to the market, you're always going to want to look at the bid price because that's the highest somebody's willing to pay you for that contract, right? If you're always basing it on the midpoint, that's I mean, there's a probability that contract could get filled, but there is no guarantee because there is not an order there, right? So sometimes, I don't know if you ever bought a contract that had a really high spread, right? It'll show that it has a lot of profit, but you can't actually sell the contract because the bid is so low, right? Have you all ever experienced that before? Have you ever bought a contract that looked like it was very profitable and you went to go sell and you couldn't sell it? right? That is usually because the spread is really high and there are no bids in the market for it, right? This really happens in what we call illiquid stocks, right? Or illiquid option chains, right? So I'll give you an example. Let me see if I can find one. So for an example, this is O'Reilly. O'Reilly Automotive is a O'Reilly Automotive is a auto parts store, right? And look at these contracts, these 1320s. They're not even that far out of the money, but look at the spread, right? The lowest somebody's willing to sell it for is $4 or $400 a contract. The highest somebody's willing to pay for it is $25, right? So it says it's a mark price of 212, right? But we know that that is not actually a accurate representation of the value of the contract. Because if we were to try to sell it at 212 and we just bought it at $4, there would be nobody willing to buy it at $2.12. If that makes sense, drop a 5 in the chat. If you have learned something or found some value thus far in the first 45 minutes of our session, drop a 7 in the chat. All right, so let's keep it moving. So essentially, Delta basically tells you, right, how this mark price is affected by price movement. Okay, so we got that. Let's go back to Tesla. Nice option chain. All right. So the next Greek we got is gamma, right? Gamma. And what gamma tells you is how fast delta changes, right? So delta tells you what that first dollar is going to do. Gamma pretty much tells you what that second dollar would do once you add that to the delta, right? So for an example, if the delta was 14 cents, right, and it had a gamma of 0.01, right, that's pretty much saying for that first dollar move on Tesla, these contracts are going to go up about 14 cents. For that second dollar move on Tesla, those contracts are going to go up about 15 cents, right? Because delta went up 1 cent, which is told to us by gamma, right? So an example, the way I like to explain gamma and delta is the example of a car, right? Delta tells you how fast you are going. Gamma tells you how fast you can accelerate, all right? Delta tells you how fast the car is going. Gamma tells you how fast you can accelerate. Okay. All right. I won't focus too much on gamma because gamma's not, especially as a novice option trader, is not a Greek that you're going to focus on a lot. But I do think it's important to give a solid foundation of the Greeks. So I do include gamma. But again, delta is usually the main Greek that you're going to want to pay attention to. And this next one that we're about to discuss here, theta. Theta, theta, theta. How many times have you sat in a contract and price hasn't moved, but that contract isn't the same value that it was yesterday, despite being the same price, the stock's the same price? If you've had that experience before, drop a 9 in the chat. That you've owned the option contract or you're in the option, the stock hasn't moved in price, but the option contract has lost value, right? Well, that is because of our good old friend theta, right? And what theta represents is the marginal change in option contract price given a 24-hour holding period. So what does that mean, right? Pretty much what that means is if I hold this option for a whole 24 hours, right, how much value would this option lose given everything else stays the same, right? So essentially, right, let's look at these 365 calls.
right? We see it has a theta value of $1.74. So what this is saying is, if I bought those contracts, those contracts at close, which were worth about $3.75, right? If I bought those contracts at close and I held them until tomorrow at close, and let's say Tesla, nothing else changes, Tesla's still at the same price, there are no other factors that have changed, I can expect that this contract is going to lose about $1.70, $1.75 worth of value. So this contract that is $3.75 would be worth $2, even if Tesla didn't move against me in price action. All right. Now, Delta is like an hourglass, right? How many times y'all know what an hourglass is? Y'all know how you got the sand in the glass and you flip it over, and when you flip it over, the sand drains to the bottom, right? But it's a slow drain, right? It doesn't all just fall to the bottom at once. It's a slow drain, right? That's what theta is, right? The total value that's going to be drained is $1.74, right? So when you flip it over to the top, it's $1.74 that needs to drain to the bottom, right? But it's not going to come off at one time, right? It's going to drain gradually as you hold the contract. All right, does that make sense? Drop a 1 in the chat if that makes sense. Okay. Now, the only time, make sure y'all got your listening ears on. The only time theta will have a immediate effect is from when the market closes to when the market opens the next day. All right? From when the market closes to when it opens the next day. So what do I mean by that? All right, let's use this example of Tesla on the screen. All right? So if these contracts are $3.75 at close, so that's at 4 p.m. 2/19, right? Now, we know that we can only trade options between 9:30 a.m. to 4 p.m. That's the only time we can trade options, right? Now, the market has to open back at 9:30 a.m. All right? Now, we can do a little bit of math, right? But we know that there's 24 hours in a day, right? Between 4 p.m. and 9:30 a.m., right, is 16 and a half hours, right? Because 12 hours would be 4 a.m., right? 13 hours would be 5 a.m., 16 hours would be 6 a.m., 17 hours. Excuse me. I said that wrong. So from 4 p.m. to 4 a.m. would be 12 hours. From till 5 a.m. would be 13 hours, 6 a.m., 14 hours, 7 a.m., 15 hours, 9 a.m., 16 hours, and then the half for the 30 minutes. So there's 16 and a half hours that pass from market close to market open the next day, all right? The thing that you need to know is theta is still happening when the market is closed. So the only time you're going to feel an immediate drop is from whatever the contract price closes at one day to what it opens at the next day, all right? So let's say Tesla does not move in price overnight, so it opens flat. So it closed at 360.56, and it opened the next day at 360.56, right? So given that parameter, we know that pretty much, let's just say 16 over 24 is 2/3, right? So we know 2/3 of theta is going to fall off overnight, right? 2/3 of theta is going to fall off overnight. So If theta was $1.75 at close, we know about 2/3 of that is going to come off our contract right there at market open, right? This is why when you swing contracts and nothing happens with that, with the price action of that stock overnight, that they open up at a much cheaper price than they were when you swung it the day before, because that theta value is going to come off immediately. As soon as those option prices update, you'll see that theta will be reflected. Other than that, theta is a drain that is so small that you normally don't feel it, right? But when you hold things overnight and those contracts have to update in price, that is usually when you feel theta the most, right? Does that make sense? Did that example make sense? If you followed that example of theta, drop a 6 in the chat. If you did not follow it, drop a 7. And it's okay if you didn't. I see a lot of 6s. Any 7s? Did anybody need me to go re-explain that? Right?
Hey, TJ,
Yep, go ahead.
question is that theta price, you got to wait till it climb up during the trading between that 9:30 and 4 p.m. in order for that value to change, right?
So not exactly, right? So what you'll notice is, right, depending on what strike you choose, also will determine your theta, right? So theta is the highest for contracts that are at the money, right? That those contracts have the highest theta value, right? But as you go in the money and as you go out of the money, you actually see that those theta values actually get lower. So it kind of looks like a curve like this, right? Where the at the money contracts are in the middle, in the money would be over here, out of the money would be over here. But theta is the highest at the money. Does that make sense? And that was actually going to be what I was going to talk about next. So great question.
Yes, I see.
So right here, right, these are the values that we're looking at, right? Now we see the values right here in the middle are the highest, right? Now, these, even though this curve looks like this, where in the middle it's the highest and at the ends it's not, these ends are not made the same. What do you notice? What do we know about contracts that are in the money versus contracts that are out of the money? We know that contracts that are in the money are more expensive, right? So while the theta value is also getting smaller, the theta value is also a smaller portion of the total value of the contract. Versus here, while theta might be getting smaller, the contract value is getting smaller too. So theta still represents a pretty large portion of the contract. So for an example, we see that this theta is 64 cents, but we see the mark value, and I got all these circles up there. Let me clean it up so y'all can see where I'm actually going. Do a different color. So let's just look at this value here. We see we got a theta value of 64 cents, right? For these 380s, right? Now, if we find a theta value that is in the money that's similar, we see we got a theta value here that is 64 cents, right? And that's where the 327.5 calls. But what we notice is while they still have a similar theta, these contracts are worth $3,000. These contracts, or $3,300. These contracts are worth 75 cents, right? So swinging a out of the money contract, right, that's worth 75 cents, and majority of that is going to come off at the morning, is a lot more dangerous than swinging that in the money contract, where even if all of that theta comes off, it barely affects the value, it barely holds a larger value in the total value of the contract. Does that make sense? If you're still following me, drop an 8 in the chat.
So again, how do we relate this, right? How do we make sense of this, right? That we know that when we're swinging out of the money contracts, right? When I mean by swinging, I mean holding those contracts for multiple trading periods. We know that we're having a high exposure to theta, right? And we know 2/3 of that theta we are not going to have any control over, because between 4 p.m. and 9:30 a.m., no matter what's happening, I cannot enter or exit a new option position, right? So this is why strike selection is so important, right? Because if you want to swing and you want to have more protection from theta, it might be more beneficial for you to go in the money, right? If you have a bigger risk tolerance and you don't mind the theta drain, going out of the money, swinging can be advantageous, with the thought of, what do we learn about Delta? That it's a give and take, right? Me going out of the money might be cheaper in price, but my delta value is small. My theta value can be high relative to my overall value, so it's a lot of risk. But if I can get that movement up and these contracts can go from out of the money in the money, I am posed to be able to make a lot of money, right? But to do that consistently can be very hard, right? But you can choose the level of pressure, right? By just modifying your strike, which changes these metrics, can allow you to really change and manage your overall risk when looking at options trading. Okay. So let me tear this out real quick. So we talked about how strike selection, right, affects theta, right? But what we didn't look at is how, if we change our expiration date, how does that affect theta? Right. So let's look at these contracts that expire in 2 days. I'm gonna lower the strikes, and then let's look at these contracts that expire in 2 months. Right. Even if we keep the theta value the same, right? I mean, even if we keep the strike the same. So let's look at these 370s. These 370s have a theta right now for the February 21st strike. I mean February 21st expiration of $1.41, right? Versus if we were to look at 2 months out at the same strike, which is these 370s, we can see that the theta is 29 cents. So what inference or what ideas should that show us, right, about how expiration dates affect theta? Let's just look at the 21st to kind of get a better idea of this pattern, right? We can look at the same strike of the 370 and see that the theta for the March 21st 370 calls is 38 cents, right? So we notice that as we add more time to the expiration, that theta gets smaller, right? It affects the contracts less, right? Which is the importance of sometimes why we say buy time, right? Because if you buy time, you're able to sit in a position and not allow just holding the position to have a detrimental effect to your option contract price, right? We also know that when we buy more time, right, that the contract is more expensive. So there is, again, another give off. More time allows for more price movement, right? Allows us to be able to allow that contract to move from a unfavorable position to favorable position, or from favorable to even more favorable. But to have that time, we're going to pay a higher premium. Okay. So Portia asked, she said, theta isn't a factor if the price opens at or closes to your strike, though. So no, theta is always a factor, right? The only time that you will not feel theta is if you are very, very deep in the money. And you can see that even if you're very deep in the money, that theta is still affecting the contract, right? You won't really feel it. Like, for example, these 130 Tesla calls for April the 17th are $23,000, right? But they still have a theta value of 0.08.
So those contracts are still losing about $8 a day, right? Now, do you really feel that a lot on a $23,000 contract? No. But theta is still affecting that contract, nonetheless. All right. No, the letters are not significant. All right. Now, I want to I wanted you all to think about when we think about theta and we think about zero DTE contracts. Actually, before we get there, I want to talk about why in the money contracts actually have protection from theta. So that's going to have me add two more columns, right? 2 hour intrinsic and extrinsic value. So, and I should have started with this, but it's okay. We'll keep it moving. So I'm going to remove all of the Greeks real quick. So, option premium, right? The mark value, right? The market price for a contract. One thing that we can say, and actually I might share this other screen real quick first, is so last week we spoke a bit about basic option terminology, and I talked about intrinsic value, right? And intrinsic value being, the value that only in the money contracts have, right? So if we look at, and I want to reshare my screen back to TOS, if we look at the in the money contracts, we can see that the mark value is pretty much the intrinsic value plus the extrinsic value of a contract, right? So intrinsic plus extrinsic gives us the mark value. We also know the mark value is the midpoint between the bid and ask, right? Now, the question is, how do you calculate intrinsic and extrinsic value? Well, intrinsic value is easy. Intrinsic value is your strike price compared to the current share price, right? So we see that we're looking at the 345 strike, right? We see actually Tesla's trading at about 359.80 after hours. So the difference between 359.80 and our 345 strike is our intrinsic value, right? Everything left is extrinsic, right? So as this intrinsic value changes, extrinsic value changes, right? Because intrinsic plus extrinsic gives us the total option premium, right? Now, the beautiful thing about intrinsic value is intrinsic value cannot be affected by theta, right? Intrinsic value cannot be withered away by theta. So what do you notice as I look at more strikes that go further in the money? They gain more intrinsic value. So that's why contracts that are in the money don't wither away as fast as contracts that are out of the money because they have intrinsic value. The only thing that can affect intrinsic value is price movement. As price moves, that's going to change the strike distance relative to the current share price, right? Which is going to change our intrinsic value, right? If price is not moving, intrinsic value isn't moving, and your protection from theta is still very much intact. Any questions here? Any questions here? If you're following along well, drop a 9 in the chat. Great. Okay. So again, intrinsic plus extrinsic value equals the mark value, right? And we know that intrinsic value is that favorable. That's that favorableness of a contract, right? The more intrinsic value it has, the more favorable that contract is. That extrinsic value is the speculative value of the contract, right? All the Greeks that we talked about, Delta, Theta, Vega, Rho, they all can affect extrinsic value, right? The only Greek that can affect intrinsic value are our price action Greeks, which are going to be Delta and Theta, right? All right. So we talked about Theta. We talked about Delta. We know Delta tells us how much money we're making based on how the stock moves. Theta's telling us how much we're losing, how much money we're losing from just holding the position, right? Then our last major Greek was Vega, right? Vega tells us how volatility affects our contract. Essentially, what Vega tells us is the formal definition is the marginal increase in option contract, the marginal increase in option contract price given a percent increase in implied volatility, right? So implied volatility is a fancy way to say expected move, right? So when the expected move for a stock goes up or an option goes up, Vega tells you how that affects the option contract, okay? So if you actually go over here and look at this value right here, you'll see where it says implied volatility, right? And pretty much what Vega tells you is if this implied volatility goes up by 1%, this is how much the option contract will be changed, right? So you see for puts and calls, Vega's positive, which makes sense because when we go back to those three drivers of option price, volatility, time, and direction, we knew that the more volatility, the more expensive the option premium, right? So no matter if we're in calls or in puts, and an increase in volatility benefits us, benefits our contracts, right? A decrease in volatility hurts our contracts, right? So, for an example, one of the most common examples of where Vega comes into play is during earnings, right? Before earnings, IV is really high for stocks, right? For that stock or that option, right? If you're trying to buy an option contract and it has earnings that week, you might hear us say that that option is juiced or the premiums are juiced, right? Because the implied volatility or the expected move is higher, right? Because we're getting an earnings update, right? But once that information comes out, there's no more uncertainty out there. The move has already happened. Well, the expected move starts to shrink. The implied volatility shrinks, also referred to as the IV crush, right? So as that IV might drop 20, 30%, right? That's why we see the change in option premiums, right? Like you might be in calls, right? And the stock might go up, but you still lost the option play. Well, that's because what changed was the implied volatility of that contract. There was a high implied volatility when you bought it, and when you sold it after earnings, the volatility was a lot lower. And the change in volatility combated what you gained from price action, which is what Delta added. So Delta was adding to your contract, but Vega was subtracting from your contract. Vega subtracted more than Delta added, so you were still in the losing position despite price action going in your favor. Has anybody ever experienced that on the option contract or in plain earnings? If you've experienced that before, drop a 0 in the chat. You bought an earnings play. It went in your direction, but when the market opened the next day, you still weren't in a profitable position. It happens. If it hasn't happened to you, great. It probably, at least now you're aware that it happens. A lot of times it happens to people early on because they feel like to be good at earnings, they just need to know where direction the stock is going. And there's so much more than just knowing the direction. You got to know what the market is expecting, right? The only way you make money in the options, as trading options on earnings as an option buyer, is if the move that happened was larger than the move that was expected, right? So if they were expecting a 7% move and you got a 10% move, then the move was larger than what the options were pricing in. So even as the IV drains out of those contracts, the delta move that you got from that option, from that stock, is going to outweigh what you lost in Vega, right? It's going to outweigh what you lost in volatility, right? Does that make sense? So, with that being said, that pretty much, I really won't spend too much time on Vega. I mean, on row, but I will give you all the definition. Again, row is and I'll go back to our PowerPoint screen. Row is how sensitive your option price is relative to interest rates. So essentially, if interest rates go up 1%, how if your interest rates go up 1%, row tells you how much your option will change in price, right? Or if interest rates go down 1%, how much your options will lose in price. All right. Now, we don't roll because it's based on interest rates, and interest rates don't change day to day. They don't even change month to month sometimes. It's not a Greek that you have to consider really at all. Now, if you are considering, the main time you use row in consideration for option contracts is when you're buying leaps, right? You're buying things 2 years out, a year and a half out, especially when we're in environments like we are now, where the Fed might be cutting rates, right? So if you might have 3 to 4 rate cuts while holding a position, a long-term leap, that could affect your option contract, right? So, again, it's really more for longer term leap positions, not something that you're really worried about if you're swinging shorter term or day trading options, right? Now, after us going through all 5 Greeks, what 2 Greeks do you think are the main 2 options or the main 2 Greeks that you should focus on as an option buyer? Type them in the chat. What are the main 2 Greeks that you think you should focus on as an option buyer? Delta and Theta. I understand why y'all say gamma, and essentially I could, if I had to put 3, I would say gamma, but the main 2 are delta and theta, right? Delta's telling you how price movement, how price action is affecting your option contract. Theta's telling you how holding that contract, just by holding it, how that is affecting the price of your option contract. Those are the 2 main Greeks that you're going to want to pay attention to, right? Now, as a day trader, you are paying attention more to delta than theta, because at the end of the day, you're not in position that long for theta to really be affecting your contract, right? Because remember, theta is a gradual thing. So if you're a scalper and you're only in positions for 5-10 minutes, it is not theta that is usually the culprit if that position is not a winning position, right? Usually it's just that price action isn't going your way, or volatility isn't going your way, because you're not in the position long enough for theta to be the issue. The only time that caveat is not true is when you're trading 0 DTE contracts, right? When you're trading contracts that are expired that day, theta affects you a little quicker, right? Because theta is what gets that contract to 0. We know that any contract that is out of the money at expiration expires to 0, right? So if you're in the out of the money contract, out of the money 0 DTE, you're on a countdown to 0, right? Theta's bringing you down to 0. Delta is based. So the way I like to think about it is when you're trading a 0 DTE, it's like having a big hole at the bottom of your cup, right? And delta is like your water fountain, right? If the stock is moving in your direction really fast, all right, well, you pouring a lot of water, and even though you losing water out the bottom, right, you're pouring water in then you're faster than you're losing it, right? So you're making a lot of money, right? But if you are not moving fast enough, and let's say you used to have a fire hose, right? But now you just got a garden hose, right? Water's not coming out as fast. Delta's not replenishing the value of that contract as fast as Theta is taking it away, right? And as long as that contract's out the money, that contract has to go to zero by the end of the day, right? So that's the harm of, or why a lot of times when we talk about zero DTEs, especially in impact, we talk about them as being a high risk trade, right? Because we know that time aspect is because anybody knows time in the market is maybe one of the hardest things to do, right? Especially early on. So when you have that contract that is losing value really fast because it is a zero DTE, unless you have timed your entry correctly and price is moving in your direction very fast, or volatility is increasing very fast, that contract a lot of times ends up losing value quicker than you can make it, right? That's why we say see profit, take profit, especially with those zero DTEs, right? See profit, take profit, right? Okay. You can combat that by easily just buying next day contracts, right? Just buying next day contracts and still scalping and day trading will vastly. I don't even have to lie to you. I can visually show you. Let's look at SPY. Here's SPY. We're going to look at I can't really. Oh, there we go. There we go. That's what I wanted to do. So this, and let's look at Theta. So this is the pink line. Let's see if I can do this right. The pink line is Thursday well, what's today? Wednesday. So the pink line is Friday contracts. The blue line would be zero DTEs for tomorrow. We can just
Share
see.
your screen, TJ.
Oh, switch the screen. My bad. Can y'all see the chart? Can y'all see the chart now?
Yeah, you're good.
All right. So when we're looking at this, right? So the blue line is tomorrow contracts. The pink line is Friday contracts, right? The theta value is on the y-axis. The strikes on the x-axis. We can just see that just by going out one more day on SPY, that the terminal or the highest theta value is a lot smaller just one day out than it is for zero DTE, right? Let me show y'all. Let me just visually show you this, right? Because I think it's so important, right? So let's just compare it, right? And right now, technically, the 19th is still the zero DTE, but we'll just look at it. So right now, as you see, this theta value, these contracts are out of the money, right? So theta has to drain the total market value of this contract because these contracts, if they expire out of the money, have to be worthless, right? So even if we were to maintain the same strike but go out one day, one thing that we see happen is that theta does actually slightly decrease, and then the other thing we see that happen is theta is a smaller ratio to the overall value of the contract, Here, theta was 100% of the contract. Here, theta is only 50% of the contract. Now, what I mean by adding an extra day, it does not matter because I love doing this math for folks, right? All right. If theta represents 24 hours, right? That would essentially what I could do is I could take the theta value of 0.69 and divide it by 24, right? I could do that, right? And what that would tell me is 0.69 divided by 24. That is 0.02875. 0.02875. Okay. So we know that equals, let's just do a little math. 0.02875. So that basically says that if I was to hold these SPY contracts for an hour, right? For an hour, I would lose roughly about 3 cents in theta. Theta would trim off about 3 cents of my value, right? Now, if I did the same math, right, and I said, all right, let's just say I bought these at open, right? So at open, we only have 6.5 hours left from 9:30 to 4. Only 6.5 hours left. So I got to take this same theta, which is now 74 cents, but I don't have a full 24 to divide it by because this theta got to get all of this value out by close. So I got to divide this by 6.5, right? Let's see what that is real quick. So if I said 0.74 divided by 6.5, oh, that's 11. That's 0.113. Okay, 0.114. We'll round up. So what that says, right? What that says is that in 1 hour, theta is trimming about 11 cents, almost 11.5 cents per hour, right? So one, I lost 3 cents. In the hour, I might be scalping, and in that hour, I realized, oh man, this ain't really moved. I only lost 3 cents, right? Relative, and remember that contract that I only lost 3 cents on is actually a $1.50 contract, $150 contract. So I lost $3 on a $150 contract, not a very small loss, right? But the same situation, we chop around for an hour, price doesn't move. And I bought a 0 DTE, right? I lost 11 cents in that situation, right? 11 cents in a $75 contract. So I've lost a lot more money on an absolute value, and it's a larger portion of the total value that I've invested, right? So this is why this is the danger of the 0 DTE, because if you do not get it correct, right, and you have to wait for it to make that move, you are exposing yourself to a larger downside risk. All right, doesn't mean you can't make good money. You can make great money, right? You just have to acknowledge the risk and size accordingly, right? So I want to kind of take a stop here. This session is pretty heavy with the math, but we were able to cover most of the parts I wanted to talk about, which were the Greeks, option premium, how it's really broken up, how the Greeks kind of affect that, and really kind of talk about the 0 DTE and the two main Greeks of Delta and Theta. So I really feel like, I hope you all were able to grasp a better understanding, a more comprehensive understanding of option value. I hope this maybe changes the way that you look at choosing your strikes, maybe choosing your expirations. I hope this was an enlightening moment. If you felt like a light bulb went off for you tonight, or you felt like this was very valuable and you were able to gather something or take something away from this, drop a 7 in the chat. If you felt like this wasn't too helpful, or maybe it confused you even more, drop a 0 in the chat. So 7 if you really liked it, grab something. 0 if it really wasn't your speed tonight. Okay, see some sevens. I see a zero. I always love when I see a zero because that means I can do something a little bit differently. Deanna, if you would, if you want to, whether it is via voice or in the chat, if you would like to say maybe what gave you the most trouble or things that I may could have done better to articulate my points.
Like I totally got everything last Tuesday, but I don't get anything today. So I'm not retaining the information. Like it's going over my head. So
Okay,
it's just kind of frustrating.
okay, okay. The Greeks, I will say that they are. It's not as easy of a topic. So for some folks, it might not be the first time you hear it. It's just like, oh, like I got it, right? It might be one of those things that you're like, I would want to go back and reread or relook at the recording, and then reevaluate. And if you still have questions, feel free to ask. Or if there's any questions that maybe or any concepts that I can maybe re-explain now, feel free to ask because that's what we're here for.
I probably would just listen to the video again
Okay.
and then probably take notes. I don't know, but it's just not matching up like the graphs. I'm not like it's just not going. I don't know. I just don't get it.
I got you. I got you. I got you. The best way that I will say when you think about the Greeks, and I'm gonna try to take it home here, and let's just give me a second. Let's just close this out. Let's close this out. And let's share a whiteboard real quick. Actually, I want to go back here because this is a good summary screen. All right. So essentially, right, when we think about an option contract, right, all the Greeks tell you are based on these three drivers: volatility, time, and direction. Right? When these drivers come from change from being just a concept to actually putting numbers, those numbers are the Greeks, and the Greeks tell you how the option premium will be changed, right? So when we look at this graph, right, and we see that delta measures the change in price, delta measures the impact of change in price of the underlying stock. So when we look at this little graph over here, right, what this really basically means, ignore the short call, ignore the short put, right? So don't ignore short call, ignore short put. Look at the long call, look at the long put, right? So essentially what this says is when we buy a call, delta positively affects calls, right? So delta measures how much an option contract's going to change if price goes up, right? So if we're looking at Apple goes up in price, Delta's going to tell you how much that option is going to change in price. All right. Going down the column. Vega measures the impact of change in volatility, right? So if volatility goes up, how does that affect the option contract, right? So if we're in calls, if volatility goes up, that is going to make your call more valuable, right? So price movement in your direction is going to make it more valuable. Volatility increasing is going to make it more valuable, right? Theta tells you the rate of time decay. How much value am I losing, right? So when you buy a call, theta is always going to subtract value from your contract, right? So delta adds value, Vega adds value, theta subtracts value, right? Then the last one, gamma, right? Gamma tells you how changes in delta affect the option contract, right? So delta is going to gamma is going to positively affect calls, right? So as we look across this row for calls, whether it's delta, vega, theta, gamma, rho, the only thing that negatively affects calls are going to be theta, right? Delta, positive, vega, positive, gamma, positive, rho, positive, theta, negative, right? So when we look at puts, right? When we look at puts, delta negatively affects puts, right? So remember, delta tells you how much that option contract changes if that stock goes up in price. Well, if we're in puts, we don't want price to go up. We want it to go down. So delta will negatively affect your puts. Vega, we know volatility is always positive for options, right? And the more volatility, the more expensive or the more valuable that option contract will be, right? For theta, whether you're in a call or you're in a put, right? Whether you're in a call or you're in a put, theta will always negatively affect option contracts, right? Now, when we look at gamma, that gets a little bit differently, but essentially, gamma is always positive because gamma is always telling you how the changes in delta, right? So gamma can't negatively affect delta, right? So always a positive thing, and essentially rho for puts are negative, right? Increases in interest rates usually are not good for equities, right? So if it's not good for a stock, it's typically not going to be good for an option. But the main thing that we want to know, right, is that when we trade calls and puts, that the two main Greeks that we want to focus on are delta and theta. Delta is telling us how the stock price is going to affect the option contract. Theta is going to tell us how long we're holding it is going to affect the option contract, right? If you can gather those two main things, everything else in this session, you'll gather with time, right? You'll gather with experience. But the main thing I want you to take away from today is delta tells you how price action affects the contract. Theta is going to tell you how time is going to affect the contract, right? And if you can understand those two concepts, everything else will fall into place.
And can I ask a quick question about the delta with the put that's being negative?
Yep.
So since the delta is negative for puts, and on here is saying that it's negative, isn't two negatives? That makes it positive, right?
So essentially, your option chain already shows it as negative, right? But essentially, delta can only really be a positive value.
Okay.
But when your option chain kind of shows it, already kind of attributes that negative portion of it. But this isn't like multiplication, because yes, a negative times a negative is a positive, but that's not the way I want you to look at that. Just know that based on the definition that delta is based on a dollar move up, since delta is based on a dollar move up, and that would negatively affect puts, that will have a negative effect on your contract.
Okay, gotcha. Okay.
Yep. Deanna, did that kind of help a little bit? I hope so. And again, if you have any questions, definitely feel free to reach out to me.
Sit down.
Go ahead, Pat. Hello.
Oh, my bad. I was talking to my dog.
Oh, no, all good. One thing I would, and Deanna, again, delta and theta are the main ones you need to know, right? Now, me as an educator, I'm never going to give you all just half of it, right? I'm going to give it all to you, right? I'm going to make sure you all are aware of all the different factors, right? But at the end of the day, the two main ones are going to be delta and theta, right? Now, as you grow as an option trader, those other ones will start to matter, right? They don't matter as much early on, but they do matter further down the line, right? So, but if you can just take away delta and theta, I feel like mission is complete. Now, one thing I will tell you all is, if you want to continue to learn more about the Greeks, because I could go into the Greeks, I could technically do a session for each Greek. There's so much information and so many things that you can really consider
with the Greeks. But if you want to dive deeper into it, right, this is the channel for you. We kind of talk about those main Greeks. Charles Schwab is a great way of having a very short video, describing these Greeks, and then I have a option playlist, option pricing in Greeks, that kind of goes a little bit further into the intricacies of um, the Greeks, right? And ultimately, why this all matters, right? Why all this Greek stuff matters is because if you understand the Greeks, and not really the numbers and the math behind it, but if you can understand the trend in the Greeks, that really helps you understand why you are choosing the strike you're choosing and choosing the expiration date you're choosing. Because ultimately, Greeks are what I call independent variables, right? No matter what you do, you can't change the value of that Greek that shows up. You can't say, I want the Greek for the Tesla 360, or I want the Delta for Tesla 360 puts to be 50 cents. You don't determine that, right? You don't determine that. But what you could say is, I want to own an option contract with the Delta of at least 50 cents. And then you know that you can change the strikes in what you're looking at to get close to 50 cents, right? You can find a strike that has a delta of 50 cents, or you could change the expiration date for that contract to see if you get a combination of strike and expiration to get the parameters that you want, right? This is the part that a lot of option traders aren't able to explain to you, right? Why did they choose that strike, right? And a lot of times they say, well, I chose this strike because it was close to my target, right? But essentially, that might not always be the best strike to choose, right? It might be that you understand that delta grows enough, so you say, okay, my target might be 360, but I went for 380 because I know I'm going to get an aggressive $10 move, so I don't need to pay such a large premium because I don't mind that the contract's not going to move so much on those first couple of dollars, but I know the fifth, sixth, seventh, and eighth dollar is really going to be where I make my money, right? And that's based on the trade that I have, right? So that's why the Greeks matter. It's not really that you understand the math or how to derive. It matters that you understand the trends and understand how can I create opportunity out of that, right? Knowing that your strike selection, the expiration selection, are the only two things you can change, right? Those are only two things that you have a drop down menu for, right? Oh, you might can't change the delta for the 350 strike today that expires on Friday, but maybe the delta for the 350 strike that expires next week is more favorable, right? It gives you a better setup, right? You knowing that, being able to modify that is why this is important, right? Not so much that you can spit out the definitions, but seeing the trends in the option chain, which allows you to efficiently use your capital and effectively manage your risk, right? So I hope you all, I know I kind of ran over time a little bit, but I hope you all found tonight's session very valuable. If you all are interested, like I said, I try to do these sessions the best I can, in a group setting, but I do offer one-on-one coaching, mentorship as well. So if you really want to dive in deeper, really like how I'm able to explain things, but just want more time and a more personalized view, definitely shoot me a DM. I do have some mentorship spots open and one-on-one slots open for those that are interested, but no pressure there. We'll continue to work through this information as a group and option one-on-one, and I'm still committed to making sure you all can be knowledgeable and confident traders by the end of this 10-week series. So again, thanks for coming out tonight. Any questions, comments, concerns before we wrap it up? No problem. I appreciate you all for trusting me to lead you and guide you on this part of your journey. I definitely look forward to interacting with y'all in the Discord, and I'll see y'all tomorrow. Y'all be easy.